we continue to believe that U.S. stocks are in the midst of a 20-year bull market. That's been our call since 2009. But we do believe that we need to see a bit of a reset in stock prices, and we do believe that investors continue to give the Fed way too much credit. Okay, so if you look at the Fed as a stock, let's think about this. The Fed can be looked at as priced to perfection. Can it make any kind of missteps? Think about what's happened so far in the fourth quarter, right? Clearly, she should have raised rates in September. She didn't raise rates in October because she didn't want to admit that she was wrong in October. The market's becoming more comfortable with a rate hike in December. So you sell the rumor, you buy the news, okay? As the economy and the stock market heats up, which we think will be the trend the first quarter of the year, we think the conjecture and commentary from the Fed is going to be a lot more important than the actual ability to change interest rates, meaning that there's a lot of change coming next year. We have a new president coming in. We've got new monetary policy, and we've got new investing habits coming in. That's a lot of uncertainty, and we think we could see a pretty sizable correction.
And third years of presidential cycles tend to be good because everybody's promising everything. Right. I mean, we're going to spend, in fact, we have a segment on that coming up in just a bit. How far do you think we could fall on the S&P next year?
We have two scenarios, Brian. Scenario number one is our base case that the market rallies to our year-end target for 2015 of 2250 as institutional portfolio managers continue to bid the market higher because they've underperformed. We see a cycle high of 2,400 sometime in the beginning of the year, then a pretty sizable correction to potentially even 1,800 or so, and then a rally back to 2,100. Now, we're not trying to be cute. We think actually we could see that type of a reset as the reactionary short-term market participant does that. Our second scenario is what consensus, what everybody else is saying.
Before we get to number two, let's stay on number one, because I think if you look at, you said a lot there in the graphics, and if you're on the radio, basically you're trying to figure out all these numbers in your head. The bottom line to me is it sounds like you're saying the end of next year will likely be lower than the beginning of next year.
Yes, we think that's the case.
So overall, the markets, while having a nice maybe mid-year pop from their lows, are going to be down from where they are right now or close to it.
That's the case, especially if, again, if what we believe is going to happen, even in this very short term, that the market's going to rally to new highs even this year as investors try to chase performance. No one's saying that, by the way. Everyone's saying, oh, it's going to be really quiet, no one's doing anything. But, you know, numbers are pretty good and the economy's pretty good and investors have underperformed this year, so that's why we see at least a near-term pop. Now, scenario number two is what everybody else is saying, treading water and the market corrects and then we close basically what we open the year in. I think that's too simple. If we've learned anything since 2009, this is a really, really, really tough job picking stocks and trying to make money for clients. And we need to rebuild credibility for equities. I think ultimately that's what the 20-year bull market says. As we move back to quality investments, that's why we think longer term we're moving more into value. Yeah. I think growth to start the year, value to end the year, and for the next 3 to 5 years.
But along 10 years from now, stocks will be higher. Right? I mean, that's the base. That's the baseline idea.
Our baseline idea has remained steadfast: 8 to 10% compound annual growth rate for stocks. Next year's the reset.